Have you been asked to find the return on investment for a target and takeover company and have no idea how to do that? Well, you've come to the right place because I'm Professor Capko and I'm going to help you do this in this video. But first, I want to say I believe something great is going to happen for you today. And now, back to the video. I have done an earlier video where one company was taking over another company. They paid more than the fair value of the net assets, and that additional amount paid was considered goodwill, and that was capitalized in an asset called goodwill. If you missed that video, you may want to start with it. I've linked it up here. But the long and the short of it is that when an additional amount is paid for a company, that additional amount is capitalized as an asset called goodwill. And that's going to come into play when we're calculating the return on investment, which is otherwise known as ROI. Here we've got a target company and it has a fair value of net assets of $100,000. When we say target company, we're not talking about the retail giant. We're just talking about the company that is targeted for a takeover. The fair value of its assets at the time of the takeover is $100,000. The takeover company, that's the company that's buying it up, gobbling it up. That's takeover company pays $150,000 cash for the target company. Now that means that we're going to have goodwill is the difference between the 150,000 and the 100,000. So we have of $50,000. The target company has a net operating income of $32,000 per year, and we project it's going to continue receiving that for the time being. So even after the takeover, that's the amount per year of the net income. Let's look at our formula is ROI, that's the return on investment, is equal to your net income over the average total assets. And we're going to multiply it by 100 because we want it in the form of a percentage. This is going to give us a decimal because we've got a dollar figure on top and a dollar figure on the bottom. Let's do it for the target company. This is the company being purchased. We know the ROI is going to be equal to our net income over our average total assets. Our net income we know is $32,000. And the average total assets, that's the fair value of the assets in this case, is $100,000. So if we divide those, you might be able to do that in your head, but I'll put it on the calculator so you can see it. 32,000, and we divide by 100,000. This way you don't get the decimal place in the wrong spot. That's 0.32. As I told you, it would be a decimal. We're going to multiply it by 100. And that gives us a 32.0% as our return on investment for the target company. If you find that accounting is difficult, go ahead and give me a thumbs up, and that way we'll know that we need to make more videos like this. Our return on investment is 32% for the target company. Now, let's do the same calculation, but this time we're going to do it for the takeover company. This is the company that's buying out the target company. So again, we know the return on investment is equal to our net income, which in our problem we've said that it's going to remain the same, and we're doing this on purpose. We're keeping it the same because I want you to see how the net assets in this case are going to change what your return on investment is. The net assets for the company, now that it has been taken over by the takeover company, is now $150,000 because that is the amount that was paid for it, and that would include the $100,000 in the fair value of the net assets plus the goodwill of $50,000, which is the amount they paid above the net asset value. So our net assets, our average net assets is 150,000. So let's go ahead and see what that comes up. So we still have the same 32,000, and I'm going to divide it by 150,000 instead of 100,000, and it gives me a 0.21333. I'm going to multiply that by 100 because I want to get that as a decimal, and that is 21.3 if I round it percent. And you can see that that is our return on investment now that it's been taken over. Note that on the same income, the income remains the same, the return on investment has dropped. And the reason being is now an additional $50,000 was invested in this company to be which was the Goodwill. So that is the extra $50,000, which raises the denominator and therefore reduces our return on investment. If you have additional questions or have a different problem that you would like me to work out, go ahead and put it in a comment down below, and I'll try and make a video for you as soon as I can answering your question. Now you know how to find the return on investment for a target and takeover company, but that's not all you need to know. So go ahead and subscribe. And click the notification bell so that you will never miss out on any of the videos. Until next time, keep your grade alive and subscribe. Thank you.